Before diving into Bitcoin, let's cover some basic investing terms and the most common way most of us store the value of our life's work, the 401k. Depending on your level of investment experience, this will either be boring or you will wonder why I am talking about 401ks. Trust me, you have to understand the current system at a basic level in order to understand what makes Bitcoin so valuable. Most people don't know it yet, but Bitcoin has become the best place to store wealth. Once I have explained what the wealthiest and not so wealthiest people have to do to preserve their wealth, explaining Bitcoin's value proposition will be simple. I will use a fictional story of a fortunate young woman who learned about the power of investing at an early age. Meet Sarah. She is 25 years old, lives in Atlanta, and works in marketing. She makes a salary of $75,000 a year. Her company encourages their employees to invest in their 401k with a stock matching plan. For every dollar Sarah invests up to 5% of her salary, the company will match it. That is essentially free money. Atlanta is a fun place to live though, and Sarah is spending pretty much everything she makes. Her parents and co-workers urge her to save early, but she finds finance confusing. She knows marketing, not money. She finally relents and decides to set up a meeting with her HR rep to help her understand the 401k plan they offer and the options within it. She learns a 5% match means her company matches her investments up to 5% of her pay. If she invests 2%, they match 2%. If she invests 10%, they will match up to 5%. This clicks for her. Things then get complicated with 15 funds to choose from, some risky, others safe. Her first thought, why risk my money? Some funds focus on bonds considered safer investments, while others invest in stocks, also called equities. Stock funds vary widely: small cap, large cap, growth, dividend, and more, each with its own level of risk. Still others invest in a mix or blend of stocks and bond in order to diversify and blend some of the riskier stocks with safer bonds. The HR rep tries to explain how these decisions impact expected volatility and return on investment, but Sarah isn't quite getting it. She is now stressed. Like most people, she is overwhelmed by her options. What happens if she makes the wrong pick? Will she lose money? What will make her the most money, and how does she decide that? Later that evening, Sarah calls her high school best friend Emily, a finance graduate, who assures Sarah she can make the decision that's best for her with a bit of guidance. They agree to meet. Bonds are essentially loans you give to a company or the government. They are considered less risky than stocks because, in case of financial trouble, loans are repaid before stockholders see any return. The downside to bonds is their limited upside. Even if the company becomes the next Google or Amazon, bondholders only earn the agreed-upon interest, missing out on the massive gains equity investors might see. Government bonds can be issued by cities, states, or the federal government. Federal bonds are considered the safest, often called risk-free. We'll explore why in a future video on inflation. Buying stock makes you a part owner of a company. You might own a tiny sliver or, if wealthy, a significant share with influence. Most of us own tiny slivers. CAP in small cap or large cap stands for capitalization, referring to a company's size. Large caps like Microsoft, Amazon, and Google are worth trillions, while small caps like Goodyear Tire are worth billions. Small cap companies are riskier than large caps. It's like crossing the Atlantic in a sailboat versus a cruise ship, riskier but more exciting. Bonds, by contrast, are like a plane ride. Some funds mix stocks and bonds, adjusting based on your retirement year. Younger investors get more stocks, while older ones get more bonds. Why? Stocks are more volatile than bonds, but young investors can handle this. A down market means buying more shares for the same money, which benefits long-term retirement savings. If you're 64, retiring at 65, and the market crashes 30%, withdrawing funds means selling 30% more shares than planned, risking the longevity of your retirement savings. With Emily's help, Sarah is beginning to understand. Bonds are safer but yield less, while stocks are riskier but offer higher returns. if you have enough time before retirement to endure and even profit from the downturns. Emily explains another benefit of 401ks. They are tax-deferred, meaning Sarah won't pay taxes on contributions at her current marginal tax rate. With marginal tax brackets, you pay higher rates only on income above certain thresholds, saving taxes at your highest bracket. Sarah's marginal federal tax rate is 22% and 5.75% for the state, saving 27.75 cents per dollar invested. It may not sound like much, but the numbers will surprise you. The next weekend, Sarah visits Emily's apartment to review a simple spreadsheet Emily created to help with her decisions. In order to make the sheet easier to understand, Emily has made a few simplifying assumptions. Sarah is paid twice a month. No raises are assumed. Tax rates do not change. Company match stays constant. The top part are just facts and the same for all scenarios. Salary of $75,000. Taxes of 27.75%. And company match of 5%. Orange lines highlight Sarah's decisions. Investment amount. Risk tolerance. ROI. Use an advisor or not. The bottom part are calculations. The most important lines to pay attention to are: how much less will Sarah bring home every paycheck based on how much she chooses to invest? How much money will Sarah retire with? How much more or less will Sarah retire with against the previous scenario? Let's go over the simplest scenario first. Sarah decides to YOLO, spend everything and invest nothing. Her paycheck does not go down a penny and Sarah is living large. But her future self is not going to be very happy. Now let's look at scenario 2. Sarah decides to take full advantage of the 5% free match her employer offers and decides to invest 5% of her paycheck in a fairly conservative fund. Sarah can't believe it. She would be a millionaire when she retires if she could just spend $113 less every paycheck without any raises at all. Then she wonders what would happen if she maxed out her 401k. Could she be a multimillionaire? The answer is absolutely. She would have more than $3 million at retirement. Emily thinks Sarah is being too conservative and suggests a stock-heavy portfolio with a 10% long-term return. They plug 10% into the ROI line, and Sarah is astonished. Her take-home pay doesn't change at all, but her expected retirement savings is almost $8 million. In the final scenario, Sarah asks Emily if it is smart to hire someone to help her manage her money. If you have to ask that question, the answer is usually no. Just buy an S&P 500 index fund. Take a look at what a 1.25% fee does to a portfolio that returns 10% a year. Sarah would lose $2.5 million in fees. But someone, probably a money manager, might say an active money manager will make up for the extra fees with higher returns. The data doesn't bear that out and is why index funds are so popular. To wrap it up, even regular folks have complicated decisions to make in order to preserve their wealth. Most of us don't have the time and expertise to think about this stuff all the time. Even if you do, there's way too much risk just to keep yourself above water. There has got to be a better way, and there is.